Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar. Bert Salazar.
Hey, good day, everyone. Welcome to another Cambridge podcast. I'm excited that you're all here. As you all know, we do these podcasts on a weekly basis, and primarily our goal is to provide education to all of you and to all our listeners in order to enhance their ability to manage money, to invest money, and to set themselves up and yourselves up for retirement. Today, we're going to be talking about a subject that I can talk all day long, and that's a subject of qualified plans. And qualified plans are plans that have been primarily designed by the government, by the IRAs code, and these are your 401ks, your IRAs, your SEP, your profit-sharing plans, your defined benefits like pension plans. Some of the largest companies in the private sector still have a few defined benefit plans out there. If you happen to be a government employee, you more than likely have some kind of a defined benefit pension plan based on income, age, years of service, time of retirement, and so forth. What I do want to talk about today, it's an issue that comes to mind every single year when I do taxes and tax planning for my clients. The vast majority of Americans, as we all know, are putting a tremendous amount of money in their retirement plans in order to, have money for retirement at some point in time in the future. There are trillions and trillions of dollars invested in retirement plans throughout the United States and in many other parts of the world where some of these plans are available for specific countries and so forth. What I do want to talk about retirement planning is the fact that most every American that invests in a retirement plan, I'm going to try to stick to your traditional 401k because obviously I don't want to create a lot of confusions. Most everyone that works for a company, if it's a company big enough that may offer some employee benefits, more than likely they're going to have some kind of a 401k available to their employees. Now, if you happen to be an executive or you own your own company, then you do have the ability to set up your own retirement plan along those lines. But let's, for argument's sake, let's go ahead and stick to someone who is an employee, could be an executive or could be in middle management or a traditional employee that works for a company that provides a 401k. Now, in 2018, you do have the ability as an employee to make contributions up to $18,500 into your 401k. Now, on top of that, if you happen to be age 50 or older, the IRS and the law does allow you to do what is known as a catch-up contribution, in which you can set aside an additional $6,000 for a total personal contribution of $24,500. Now, there are many 401ks out there that the employer does provide a match. So the match would be in addition to whatever the employee is contributing. And there are also many companies that do not provide a match. Now, one of the challenges that I see with my clients as we do tax planning is that the vast majority of their assets is primarily invested in qualified plans, traditional 401k plans, and so forth. And that would be the vast majority of all their assets. Some have more assets in real estate, but for the most part, the vast majority of the people that I talk to, the biggest portion of their retirement savings is in 401k. Now, I'm not saying by the statements and the things that I'm going to be mentioning in the next few minutes that 401ks are all bad. What I am saying is that if you're going to start investing in a 401k in your 30s or your mid-30s or early 40s or even younger than that, you have to be very careful. In other words, you have to invest and you have to start with the end in mind. What is it that you're trying to accomplish? Now, the first thing that most people want to do, especially if they're making good money, is that they want to max out on their contributions to the 401k every year. And then obviously, if they're not above the age of 50, so they'll put $18,500 away. That money grows tax deferred. So if you're making $100,000 and you put $18,500 away, then you're going to be taxed on the difference, which is about $81,500 from that perspective. And you know, most of the financial advisors out in the marketplace and most of the tax preparers and CPAs that I deal with will actually tell their clients that by putting money in a 401k, they're saving money on taxes. And that's a misnomer, because you don't save money on taxes when you put money away in a 401k. The only thing that you're doing as an employee, contributing to your 401k or any other type of retirement plan, is that you're deferring the tax. And the problem with deferring the tax is that you're also deferring the tax liability. And no one has a crystal ball. No one knows what taxes are going to be like in the future. Now, I can tell you, based on the American economy and the amount of debt that we have in this country, there's a very high probability, although we have just gone through some tax reductions under the Trump administration, but no one knows what's going to happen to that afterwards. One of the big things that we have in the government is that, these tax cuts that we have seen as of January 1 of 2018 on the individual side are going to be primarily temporarily at this point, unless Congress does something else to make them permanent. That's going to be a big issue, because obviously it's going to have to be debated in Congress, and most important, it's going to have to be approved by at least 60 members of the Senate, and that's almost an impossibility, especially with the fact that there's so much division going on politically in our country today that's hurting the vast majority of Americans. So in any ways, you're putting away $18,500 away in a qualified plan. But because of the fact that no one knows what the taxes are going to be in the future, and no one knows what the tax liability is going to be for you, and for all the listeners on this call, it's very difficult to identify how much in taxes you're going to have to pay on that money. Most important, when it comes to 401ks or IRAs or SEPs and so forth, you have very, very little control, if any, of your money. Now, think of it this way. If you were buying a piece of property today, let's say you were buying a real estate property today, and as part of the contract and the purchase of that piece of property, someone were to tell you that A, you could not sell that piece of property until you were at least 59 and a half. And if you did, not only did you have to pay taxes, but you would also have to pay a 10% penalty to the IRS. Would you buy that kind of a property? More than likely, the answer would be no. What if the same property that you're trying to acquire would say to you that between 59 and a half and 70 and a half, you can buy it, you can keep it, you can lease it, you could do whatever you want with it. But starting at age 70 and a half, the government is going to force you, or the owner, the former owner of the property, or the contract that you signed is going to force you to sell that piece of property, because if you don't, whether you want or not, you're going to have to pay taxes, plus you're going to have to pay a 50% penalty. Yes, you heard me right, 50% penalty. How many of you would buy that piece of property? How many of you would buy that piece of investment? How many of you would make an investment where you really have no control of your assets? So if you think that the average American lives, according to the statistics, 84.6 years of age, let's say rounded off to age 85, and out of 85 years of your life, you only have control of a property, an investment, or something in your life for 11 of those years, How many of us would put money or would invest money in that type of property? Yet we do it every single day in a 401k, and that's how it works. Now, moreover, also think of it this way. The IRS, the money that you're deferring, you see, what belongs to the IRS always belongs to the IRS. So if you were putting away $18,500 a year and you were in the 30% tax bracket, then the IRS is saying, look, don't pay me that tax right now. I'm going to allow you to keep it, and you can invest it. But then at some point in time in the future, I'm going to ask you for that money back. And when I ask you for that money back, I will then determine how much I'm going to charge you as far as taxes on that investment is concerned. How many of us would do that? See, the problem is that we don't think about this. Let's say that you went to a bank and you went to borrow, I don't know, $100,000. And the banker said to you, hey, John or Jane, here, I'm going to give you the $100,000. You don't have to pay me back right now. You know, I don't need the money. The bank is doing very well. As a matter of fact, I'm not even going to charge you an interest rate right now. But at some point in time in the future, I'm going to come knocking on your door, and I'm going to say, John, Jane, I need to have my money back. And then at that point in time, I am going to determine the fees that I'm going to charge you for that loan and the interest that I'm going to charge you for that loan as well. Now, would you sign a loan agreement with that bank in order to acquire that $100,000 loan? More than likely, the answer is no. Yet, we all do it with 401ks and qualified plans every single day of the week. Now, another issue that the vast majority of tax preparers and financial advisors out in the marketplace do not advise clients about is that, you know, putting money away in a qualified plan could be a good accumulation vehicle, but it is a horrible distribution vehicle. And the reason why it is a horrible distribution vehicle is that at the time that you're obligated or you decide to start taking money out of this qualified plan because you're already retired, and you do so in order to maintain your standard of living, you're not only going to trigger taxes on that distribution, but that distribution may trigger taxes on many other areas of your life that you haven't even thought about. For instance, depending on the amount of income that you generate in retirement, and depending on the amount of distribution out of your qualified plans, a percentage of your capital gains distribution, if you have some investments in real estate or stocks or investments like that, may actually be taxed where before they wouldn't have been, or at least you would have been sheltered for a large portion of that capital gain. But because of the fact that you took money out of an IRA or 401k, that may trigger not only taxation on that investment or that distribution, but also on your capital gains. How about your Social Security benefits? If you're married and both you and your spouse are retired and you're collecting Social Security benefits, if 100% of your reportable income for the year is Social Security, then you would not pay any taxes on Social Security. Yet, when we do and perform provisional income calculation for our clients, we take into consideration, and there's a specific formula that the vast majority of advisors in the marketplace have never encountered, and they've never had to deal with. And the provisional income calculation formula would take, when you get ready to file your taxes, 50% of your Social Security benefits that were paid out to you and your spouse for the year, 100% of the distribution from your qualified plans, 401ks, IRAs, etc., capital gains distributions that you may have had in the year, and also, last but not least, municipal bond funds. Yes, municipal bond funds are received, as we have covered in other podcasts, tax-free, but they do have a negative connotation when it comes to your Social Security benefits. So when you add all of those figures, if the total amount exceeds the thresholds for married filing jointly, which is $32,000 to $44,000 and above that, then 50% of your Social Security benefits, or even up to 85% of your Social Security benefits, may also be taxable in retirement. Now, most people say, well, Bert, if I'm going to be retired, would I not be in a lower tax bracket? Well, the answer is it depends. And based on all the calculations that I have done for many of my clients over the years, I would argue that if you happen to be in a lower tax bracket in retirement, unless you planned for it and you did your due diligence and you did proper planning, there's a very high probability that you have been a financial failure, because you don't want to be in a lower tax bracket in retirement. And the probabilities that you're going to be in a lower tax bracket in retirement is slim to none. Number one, unless you've done proper planning, unless you have followed some of the techniques that we use in our weekly webinar, which is how to divorce the IRS in retirement, which is an awesome webinar that you should all sign up and listen and watch. There's a very high probability that your taxes are either going to be the same as they were before you retired, or perhaps even higher. And the reason why I say perhaps even higher is because your deductions are, many of them are going to go away. If you have a mortgage and you paid it off, you no longer have any deductions. Obviously, in 2017 and before that, if you had kids and the kids are out of the house, well, you get no exemptions. And some of the credits that you may have been able to enjoy previously, you may no longer have. So even if you have the same income in retirement than you had before you retired, your tax liability may be greater because you don't have anything else to offset that income coming in. So one of the major plans that we do for all our clients is we do provisional income calculation, meaning we're going to do all the calculations to make certain that the client understands how much money they need to put away in their 401k every single year in order to minimize and or eliminate their taxes in retirement. And you have to do net present value calculations and all kinds of calculations that most of my clients have no clue where to begin, although many of them are professionals and very intelligent, but they just don't understand accounting. And that's what we do so greatly here at Cambridge. In addition to that, for those of you that have had the ability to put money in Roth vehicles, we highly recommend Roth accounts. Now, some of the 401ks that I'm starting to see now in the marketplace, and some of those that I actually put together for my clients, I make certain that in the plan document for the 401k, there's also a feature for a Roth 401k or a Roth IRA. You see, when it comes to taxes, the IRS gives you a choice. You can either pay the taxes today, or you can pay them as you go along year by year, or you can defer your taxes into the future. Now, the decision as to how do you want to pay your taxes is entirely up to you. But unless you have some professional education, you're not going to know the difference, and you're not going to be able to see the booby traps as you're approaching that road of retirement in the future. Now, always remember that qualified plans are good for accumulation, but they're not very good for distribution purposes because of all the tax liabilities that come with them. Now, one of the analogies that I make for many of my clients is what I call the mountain analogy. And the mountain analogy is, well, if you happen to be a mountain climber and you want to climb Mount Everest, what is the goal of every single mountain climber? And 99% of my clients tell me the same thing. Bert, the goal is to make it to the top, to make it to the summit. And I would argue that that's only half of the goal. The goal is not only to make it to the summit and take some beautiful pictures up there. By the way, you can't stay in the summit more than maybe 18 to 20 minutes. But the goal is to make it back down safely back to your family. Over 73% of all the people that have died on Mount Everest have not really died on the way up. They have actually died on the way down. So when it comes to retirement planning, is not only the taxation, which is one of the major eroding factors that Americans are going to have to deal with, but most important, inflation is going to play a major role. And also longevity planning is going to play a big role along those lines. Why? Because people are living longer today than ever before. But just because they're living longer today doesn't mean they're going to be any healthier. So having a clear understanding of how to divide your assets and set your assets aside and making certain that you have certain assets earmarked for retirement distribution on a guaranteed basis to cover all of your basic necessities is paramount if you want to succeed in retirement. So those are conversations that I have with my clients every single day. Whether we do it in person, whether we do it over the phone, whether we do it over video conferencing, whether we do it through these podcasts that I do every single week or webinars, our number one goal is how to help our clients divorce the IRS in retirement and to do so legally. Now, when it comes to retirement products, there are many things that clients are not aware of. There are only 3 vehicles under the IRS code that have no negative impact. Again, let me repeat that. No negative impact in retirement when it comes to retirement distribution. Number 1 are your Roth IRAs. Number 2, your Roth 401ks. And last but not least, life insurance contracts under Section 7702 of the IRS code. I call these plans PIRPs, PIRP, Personal Insurance and Retirement Plans, because if you truly know how to structure, if you work with an advisor that truly knows how to structure a life insurance contract under 7702, the IRS has not given any other product in the history of the world, at least in the history of the United States, more tax benefits than life insurance does. The key thing with life insurance planning and using it as a supplemental retirement plan is that if you do it properly and you retire properly and you do your proper calculations, the amounts of money that you can take out of these life insurance contracts on a tax-preferred and tax-free basis are second to none. Now, Roth IRAs and Roth 401ks have limitations. Life insurance, by the way, also have limitations. And they come in the form of what they call the 7 pay rules. And those rules have changed over the years. There's something called a MEC, which is a modified endowment contract, which means that if your contract is, if your life insurance contract is now a MEC, then obviously you have missed or done away with one of the biggest features that these contracts have, which is for you to be able to pull money out on a tax-preferred basis. But I like to use MEC for planning purposes, and I call it something else. When you do planning with a firm like mine, a MEC is a maximum efficient contract. Maximum efficient contract. See, we're going to fund the contract to create a supplemental retirement plan for you and your family that you cannot outlive, and we're going to do it to the very, very maximum and right up to the stratosphere of the IRS code, meaning that we're not going to put $1 more than what we need to or $1 less. That is why it is so efficient in order to do so. Now, although municipal bond funds are received tax-free, if you set them up properly, they do have, as I stated earlier, a negative connotation when it comes to distribution planning and Social Security. Roth IRAs, Roth 401ks, and life insurance distribution will not have a negative impact on your Social Security benefit. As a matter of fact, I have worked with clients over the last 10 years and 15 years where we have done this type of planning for, in which, I did cover a podcast on one of these clients, and I did a webinar for one of those clients. Obviously, I had to change the names to protect the innocent, in which these clients had actually contributed money to a qualified plan, to a 401k, to an IRA. They also were able to fund a lot of money to the Roth 401ks and Roth IRAs. And also we created under 7702 a maximum efficient life insurance contract. And by the time these guys get to age 65, they're going to be able to pull out their Social Security benefits totally tax-free. Obviously, they're going to be able to pull out money from the Roth IRAs totally tax-free. They're going to be able to pull all the money in the world out of their Roth 401ks tax-free. And they're going to be able to pull money out of their 7702 retirement plan totally tax-free. To the point that based on the calculations that I did for these clients are going to be generating in excess of $180,000 a year. Yes, you heard me right. $180,000 a year in income with a 0% tax liability and a 0% tax bracket. Now, that is efficient planning. It's not just putting money away in a 401k. Now, some people may say, well, Bert, wait a minute. You told me that these clients were putting money away in a 401k, but if you're saying that when you put money in a 401k, the money goes in on a pre-tax basis and money grows tax deferred, and you pull it out tax-free, and when you pull it out, you have to pay taxes. How can you tell me that now you're going to be able to pull money out of a 401k or an IRA and not pay taxes on that money? And the answer is, well, you'll have to pay taxes on that money, except that based on the proper planning that we do through efficient provisional income calculation planning, we're going to be able to pull sufficient income out of those qualified accounts, 401ks and IRAs, and also offset that income with the standard deductions and the credits that our clients are receiving during retirement, which would offset the tax liability on those qualified plan distributions. So in reality, you have a zero-sum game from a business perspective. So that's efficiency at its best. Most important, if these clients are now generating 180, 190, 175, I have one that I just worked with, and they didn't have as much time. They only have about 9 years before retirement. They're going to be able to receive $98,000 and change in tax-free income on an annual basis. But these people are going to do it in a way that they're going to be able, because they have zero liability and the vast majority of this money is not reportable on a W-2, they're going to be able to qualify for government benefits if they wanted to, like Medicaid or food stamps. Now, who would want to do that? I mean, if you're a decent human being and you're making $180,000 a year, you're not going to try to take food stamps or any other government program where somebody else could benefit more from it than you do. But my point is, in this podcast, is to let you know that if you do proper planning, you can put money away, you can take tax deductions today, you can definitely take the vast majority of your tax deductions in the future, because taxes are going to be much, much greater in the future than they are today. And by the way, what is better? Paying 22, 32, 42% in taxes, or paying zero? Another question that I ask my clients is, well, based on all the assets that you're going to have in retirement, what percentage of those assets would you like to have taxed? Guess what the answer is? 0. 100% of my clients are telling me that they wish they wouldn't have to pay taxes in retirement, and in reality they don't have to. But because of the fact that they blindly started putting money away in qualified plans without doing any due diligence, without having an exit strategy in mind, there's a very, very high probability that they're going to end up paying more in taxes in retirement than they ever did before they retired. So again, feel free to reach out. We're here to help. We're here not only to help you, but also to educate you, because we feel very strongly that information without education always leads to failure. And most important, as I'm finishing this podcast now, what I tell you every single week will never change. My goal and the goal of my firm is to help you change the way you see things. Because when you change the way that you see things, the things that you see change. Thank you, and have a wonderful, wonderful day.